Good afternoon. It is Friday afternoon, January 6, 2023. This is Rob McDougall with Zhang Financial with a special edition of our weekly economic update. Special because I'll be out next week. We normally do this on Monday, but today, Friday, we'll just recap the economic news we've seen so far this week and how the markets have responded to it and discuss economic data points coming out next week. So this week was a very eventful calendar in terms of economic data. First large piece of news we got was Wednesday, the December ISM Manufacturing Index. Now this has been weak. It is a ugly looking chart. It's been down 7 consecutive months. It was expected to come in, the manufacturing index was expected to come in at 48.4. It came in at 48.5. So about as expected, but again, 7 consecutive months in a row, this manufacturing survey has been down month over month. Friday was a big day. Today, we had a number of economic items. The December U.S. non-farm payroll number, jobs added for the month of December, a little bit stronger than expected. The consensus expectation was 210,000 jobs to be added. It came in at 223,000, but you look under the covers a little bit, it appears those were not necessarily high-quality jobs, which has been the case over the last several months. We've continued to see job additions of over 200,000, really over 220,000, but it appears a lot of these jobs are actually second jobs for individuals and not necessarily new jobs or people coming back into the workforce. Also on Friday, and more importantly, was the U.S. average hourly earnings, which was supposed to come in with a month-over-month increase of 0.4%, but it came in at 0.3%. So you would think maybe that's negative news because the consumer has less to spend. But right now, investors most definitely focused on inflation and what the Federal Reserve response will be to inflation. So actually, this lower number, the 0.3 versus a 0.4, has been received very well by the markets today. I'll talk about that in a moment. Also today on Friday was the ISM Non-Manufacturing or Services Index. Now, this index has been up consistently over 55, really since the beginning of the COVID scare, but we had a very negative data point and a surprise. It came in at 49.6. The expectation was it would come in at 55.0. So it looks like services really kind of fell off in the month of December. And again, just like the average hourly earnings index that we just talked about, the fact that this appears to be a negative data point, the market is actually kind of excited by it because, it suggests less inflation in the future, and that's what all investors are focused on at this point. So last couple of data points for this week is talk about the fact the Atlanta Federal Reserve, their GDP estimate for the fourth quarter, they revised it up again yesterday from 3.7% to 3.8%. That I think might be their last estimate for the fourth quarter. So if they're even close to correct, that would mean 2 strong quarters in a row of GDP growth for the U.S. economy, which seems to be juxtaposed versus some of the economic data that we've been seeing most recently. So most economists are far below the Atlanta Federal Reserve's estimate of 3.8. In fact, the blue chip economist forecast that was conducted at the beginning of December came in just over 1%. So we'll see who's right. It does feel a lot like the Atlanta Federal Reserve estimate of 3.8% might be high. Inflation expectations. This is real-time data. So here on Friday, that number has actually come down. This is the 10-year that we always use, 10-year Treasury minus 10-year tips, and that came down from 2.3% last Friday down to 2.22%. So it's dropped another 8 basis points. Again, this metric means investors are betting that inflation in the U.S. over the next 10 years is going to average 2.22%. So the Federal Reserve rate hike coming up on February 1st, the odds of 75 basis point hike went down from last week. It went down from the week before. This week, as of today, it's at 23.8%, meaning 76% probability of only a 50 basis point hike when the Fed meets and announces their rate hike on February 1st. So, however the market's reacted, well, we don't have all the data today. The market is not closed yet. Through Thursday, so Tuesday through Thursday, S&P 500 was down a little bit. It was minus 0.79%. But based on the two metrics that I mentioned that were very favorable for inflation, average hourly earnings being below what was expected, and the services PMI being well below what it was expected, the S&P has staged a strong rally here on Friday, about an hour left before close, and that's up 2.5% on the day. So bonds going from Tuesday to Thursday this week, they were up about 78 basis points. That's the Bloomberg U.S. Aggregate Bond Index. They are also rallying at this point. So it's going to be a strong week for bonds, and also it appears to be a positive and fairly strong week for equities as well. Next week, the calendar. 2 categories, 3 total items coming up. 2 inflation, 1 consumer sentiment. So on Thursday, we're going to see core CPI inflation and also see regular CPI. So the regular CPI, that's with food and energy, that is expected to come in at 6.5%. That's a year-over-year measurement. That was 7.1% in November. So again, this is a really good chart. June, we were at 9.1%, and it's gone down since 5 consecutive months. This would be the 6th if the consensus holds. CPI core also going to be released. That is expected to be 5.7% year over year. It was up 6.0% in November. So again, that's moving in a favorable direction. Last data point for next week is the January University of Michigan Consumer Sentiment Index. That's expected to be roughly flat, just up a smidge. It's expected to come in at 60.0. Last month came in at 59.7. So that was just a quick recap of this week and what we expect for next week. That's all we have. No broadcast next week, so the next podcast will be a week from Monday. So I hope we have a great weekend, great week. We'll see you in a week and a half. Thank you.